been running Markel Group for decades. Last week, he published his 2025 shareholder letter. 5 lessons inside it apply directly to how you should think about building long-term wealth. And one of them involves a $2 billion interest-free loan that most investors have never heard of. Markel Group started in 1930 as a truck insurance agency in Virginia. Today, it manages $37.4 billion in invested assets across insurance, industrial, and financial businesses. Gayner uses one word to describe what he's building: home. This video unpacks 5 specific lessons hidden inside and what each one means for investors focused on compounding wealth over decades. Lesson number 1, culture is not a soft input. Gayner's case is this. Markel acquired a company called Educational Partners International in 2024. The owner, Deborah Martin, was running EPI out of Swanona, North Carolina when Hurricane Helene hit. Her offices were destroyed. She kept the business operating anyway. She kept her community together. That outcome, keeping a customer, keeping revenue, keeping an acquisition intact, is what Gayner means when he uses the word craftsmanship. It compounds into results on a balance sheet. Shareholders' equity grew from $16.9 billion to $18.6 billion in 2025 alone. A 21-year track record shows intrinsic value per share growing at 15% annually. And as you've heard me say ad nauseum, if your intrinsic value grows at 15% annually, it will double in 5 years. So if your intrinsic value doubles in 5 years, and we have the patience to wait for share prices, these are market prices, to catch up, we have a double in 5 years. That's the financial advice behind Gayner's cultural argument. Lesson number 2, and this is another thing that we bring to bear for all you guys. A deferred tax liability can be a structural advantage. It is for you, and it is for Markel. Gayner calls it the solar panel analogy. Here is the math. Markel's stock portfolio holds almost $9 billion in unrealized gains. That means those are gains that the stocks have gone up since they bought it and they've never sold. Those gains produce economic returns every single year. But because Markel has not sold the underlying shares, no capital gains tax is triggered. At a 22% effective tax rate, that represents approximately $2 billion sitting with the U.S. Treasury. A zero-cost, zero-maturity loan being reinvested every quarter. I worked with a client recently who was sitting on a large unrealized gain position in one single position. The instinct was to sell and diversify. The right question, though, was whether the tax bill, which gets triggered the moment you sell, was worth paying before that capital had finished compounding. In Markel's case, that $9 billion in gains exceeded Markel's entire value, market cap, as recently as 2016. Patience changed that arithmetic completely. Lesson 3, conservative reserving for an insurance company is a bedrock, not a safety blanket. Insurance companies fail in one predictable way. They underprice risk, set insufficient reserves, and one bad year wipes out a decade of profits. Gayner's principle is the opposite. Markel sets reserves that are, in his words, more likely to be redundant than deficient. In 2025, that discipline produced $484 million in reserve redundancies. And that was the 21st consecutive year of favorable reserve development. That means they could release the reserves because they were so conservative at the time that conditions have grown such that they can now release those reserves into income. So that was the 21st consecutive year of favorable reserve development across the 2008 financial crisis, COVID, and recent catastrophe years with hurricanes and the like. That streak matters because reserving is a lagging indicator. Problems don't surface for years after policies are written. A 21-year record removes legitimate doubt about the discipline behind the numbers. The same conservatism governed the $37.4 billion investment portfolio. Markel held high-quality fixed income while competitors chased higher yields in private credit. In other words, Gayner and Markel were not enticed because yields were so low. They didn't chase higher yields and higher risk assets in private credit. We know what's going on right now. There is a problem in private credit. They don't own that stuff. So net investment income reached $970 million in 2025. Lesson number 4, decentralization is a capital allocation tool. Gayner describes a structural problem that emerged inside Markel Insurance. The organization had grown too centralized. Underwriting and claims authority pulled away from frontline people who actually know the customers. He calls it internal rot. We economists call it the idea that you want to make you want to give decision rights to people that have specific knowledge that doesn't flow up to the center. Anyway, the fix was simple in principle, but difficult in execution. They were going to push every decision back to the closest accountable person with a clean owner for each one of the profit and loss statements. The results confirmed the logic. The international division posted an 83% combined ratio in 2025, with a 14% growth in gross written premiums. A combined ratio below 100 means the insurer pays out less than it collects. It's a margin, if you will. An 83% ratio before investment income is even counted represents a 17% underwriting margin. The personal lines division posted an 82% combined ratio, and these are exceptional numbers in any insurance environment. And then, of course, lesson number 5, buybacks and per share math. Lesson 5, share count reduction changes the per share math over time. And of course, that's what we're maximizing for, per share shareholder wealth. Since 2016, Markel has cut its outstanding share count from 14 million shares to 12.6 million shares, a 12% reduction. In 2025 alone, the company repurchased 425.5 million in shares. The arithmetic is straightforward. When a business produces consistent returns and reduces the share count, each remaining share claims a larger fraction of the earnings, the equity, and the unrealized gains. That free loan from the government, for instance. Combined with a 12% increase in intrinsic value per share in 2025, buybacks are not financial engineering, as some people say. They are the output of disciplined capital allocation working across all 3 of Markel's engines of growth: insurance, investing, and operating businesses. At today's stock price of roughly $2,080 per share, Markel's market cap is near $26 billion. The $8.9 billion in unrealized equity gains or stock gains represents more than a third of that entire market value, sitting untaxed on the balance sheet. Markel is not a bond proxy. It is not a growth stock chasing momentum. It is a compounding machine with 3 income streams: underwriting profit, investment income, and operating businesses cash flow, each designed to hold up across all economic cycles. Hey, if you're serious about building long-term wealth through ownership in businesses like Markel, we've got a bunch of them. The link in the description and the pinned comment below will take you to a free review of your 401k choices. We look at where you are, where you want to be, and whether the companies you own are actually aligned with how long you plan to hold them. For the next video, if you want to understand exactly how great businesses use share repurchases to build per share value without ever paying a dividend, watch this one right here. It is one of the most misunderstood mechanics in all of long-term investing. Thanks for listening. See you next time.